So I recently did a video as to why resort style complexes sometimes don't make good investments, and I wanted to unpack that a little bit further. So the previous video was short and sharp, where I used that live example in Palm Cove where that investor lost the best part of $200,000. And there were five key reasons as to why I believe he lost that amount of money, and I wanted to unpack that a little bit further in a video like this. So the first reason I said why that investor lost a significant amount of money was the fact that the property didn't appeal to owner occupiers. And what I mean by that, owner occupiers make up 70% of the total transaction volume in any given market. Sometimes on a particular street or particular pocket, owner occupiers make up 70, 80, 90%, 100% of the transaction volume. So when you don't have a property that appeals to that demographic or that market, then really you're only appealing to then a smaller fraction, which is the investor market. And investors, they're sometimes irrational. They move with the ebbs and flows of the market, and they move with interest rates, but they also move when there are economic downturns and upswings. So they can be unstable when you have a property that only appeals to investors, because investors can sometimes be irrational, whereas on the other hand, owner occupiers are generally there for the long term, and they're the ones that buy with emotion, get emotionally attached to property, and then drive up house prices. So when you have an asset that appeals to that market, then you have a better exit strategy with the market there, but at the same time, there's a lot of upside potential because these buyers will pay a premium for that type of property. And in addition to that, most home buyers have a tendency to rent where they want to live and then potentially buy into that area. So when you have an investment that appeals to that market, you also get premium rents as a whole. So that's really good from an investment point of view, to have an investment that appeals to that owner-occupier market. Number two was that it needs to be in a good location, not only in the complex, but within the suburb and within the town. So location is important, and when we are buying apartments, units and townhouses and complexes, from a complex point of view, we're looking for, let's say, north facing, we're looking for apartments with views, we're looking for apartments with courtyards. So you want to make sure you buy within the right location within that complex, right? So location is important. And then when you're looking within the suburb, you want to make sure that you're buying within the right location within the suburb, where you're going to get higher returns, where there's higher demand for that type of product, etc., etc. And then obviously the right location within the township. And when you get those three right, you generally have really safeguarded your asset there, mitigated a lot of risk, but at the same time maximized a lot of potential there. Number three was that it needed to be scarce. So why that's important, everything boils back to supply and demand, right? When there's an oversupply of a particular property, asset type, and there's just not enough demand, then obviously prices will go down, because people, in order to liquidate those assets, need to sell at a loss or to meet the market where it is in terms of price to then sell the asset. And that's exactly what happened in the case with that example, where that investor purchased it for, what was it, 570,000, had to sell for $355,000, because there just wasn't a market there that was willing to meet him where he probably needed to be or wanted to be, at around that $600,000 price point, unfortunately. So he lost a lot of money there. So everything boils back to supply and demand. So when you have an apartment or unit or townhouse that's in a big complex where there's over 200 of the same type of product, then, and there's not a demand for that type of product, that's where there is an overabundance of it. And when there's an overabundance of it, that's a big issue for you as an investor, because you generally have to sell at a loss there, because there's just not enough market depth there to pay a premium for what you own, right? So it all boils back to supply and demand. And when we buy units, apartment and townhouses and complexes, we're usually looking for complexes where they're smaller and boutique in nature, generally maximum a total of 40 units, apartments and townhouses within that complex, so that you can get a really nice, healthy land to asset ratio. They generally have better owner occupier appeal, generally in better locations. All of those other critical factors that I did mention, you want to make sure you incorporate that into the purchase. So yeah, supply and demand is a big one when it comes to scarcity. So you want to make sure you buy something that's scarce to avoid having to liquidate at a loss. Number four was the fact that it lacked upside potential through renovations. And it's a big one when you buy to hotel chains. Sometimes they don't give you the ability to do renovations or make configuration adjustments to the apartment. And when you have a property that you bought 20 years ago and it's still in the same condition as it was 20 years ago, fixtures, fittings, floor plans, etc., then obviously that's not going to appeal to, let's say, the current market right now and their needs and requirements and expectations as to what the floor plan should look like, the fixtures and fittings. So you've really lost that ability there to add value to the property when you bought into these big complexes that don't give you that wiggle room to make those adjustments. Usually when you buy into the smaller boutique ones, you have that flexibility where there is a high portion of owner occupiers and it's not attached to a hotel chain where you can't really do anything to change the configuration, fixtures and fittings, do renovations, etc. So you want to make sure you always target a big resort complex or a smaller boutique complex where you have that ability to at least add value. Otherwise you put all your eggs in one basket there. And the last reason was the fact that the extravagant holding costs. A lot of the time as an investor, when you buy this type of asset, the holding costs are huge, right, for body corporates, maintenance fees, etc., as well as management fees to the hotel, etc., and to people that are managing the joint. And that can really deter a lot of investors and even owner occupiers from buying your property when they see body corporate bill of $17,000, $18,000, $20,000. Obviously that eats into your cash flow as an investor and also as an owner occupier, particularly if you're a retiree wanting to downsize into a low maintenance apartment and you see those extravagant body corporate fees. Obviously that's going to deter you away from that property. So those are some of the key reasons why I believe this investor lost money. And if he ticked all of those 5 boxes, I believe he would have ended up buying a better type asset, a better quality asset in a better location that is scarce in a smaller boutique block that has renovation and upside potential, that is in the right location. What was the other one? And that has lower holding costs. So all of those key things, if you stack them on top of each other, you mitigate a lot of your risk, but at the same time, maximize a lot of your investment potential. Let me know your thoughts and I hope that's helped.